All right, what's up, everyone? You are live. It's been 2023 real estate market predictions episode. We have a really good panel. I think you guys are going to get a ton out of this. I actually made sure I've got some notes with me because I've got some questions I want to make sure I ask the panelists before I let them go today. Today, we are going to talk about a few things. Number one, we are going to talk about your 2022 experience. And let's be candid, no fluff. We are also going to get into our 2023 market predictions. So what's going to happen? We are going to be economists today and psychics today. We are also going to talk about what each one of the panelists' strategies are going to be for 2023. What are we going to do to prepare? So without further ado, I want to introduce everybody. I'll start with myself. My name is Lauren Hardy. For those of you who do not know me, I'm a real estate investor. I primarily fix and flip. I've done development and I've done a ton of wholesaling for the last 10 years. I am also a real estate coach. I will go around and introduce everybody. So Sharad, go ahead, unmute yourself and introduce yourself.
Thank you, Lauren. My name is Sharad. I'm the owner and founder of REsimpli.com. Also an active investor in Northwest Indiana market. I live up in Toronto, Canada, but I do my investing in Northwest Indiana, right outside of Chicago. And I also own about 50 rental properties and a property management company.
Sharad is a machine, you guys. I love him, good friend of mine. And Seamus, you're next. TurboTenant, Seamus, please introduce yourself.
Awesome, thank you. Yeah, my name is Seamus Nally. I am the CEO of TurboTenant. TurboTenant is a platform where we've been privileged enough to serve over 500,000 independent landlords. They use our platform to self-manage their rental process, everything from screening, filling vacancies, to leasing, rent payments, and then dealing with those little things that come up like maintenance requests. Outside of that, I also self-manage 22 doors. While I live in Colorado, my properties are actually located in upstate New York, where I grew up. So kind of doing some remote management from that standpoint.
Awesome. Well, thank you for joining us today, Seamus. Now, next is Devon. Devon, you're looking good in orange.
Yeah, kind of bright. I know. I'm kind of standing out. But yeah, my name is Devon Kennard. I'm in my 9th year in the NFL, actually. I've played for the New York Giants, Detroit Lions, Arizona Cardinals, and most recently, Baltimore Ravens. I've been a real estate investor since my first year in the NFL. I currently have 22 properties, majority of which are turnkey properties, but I've also invested in over 30 syndications as a limited partner and a couple of GP general partners. And I love real estate. It's outside of football, it's what I'm passionate about. So I'm glad to kind of join you guys and be able to, put my 2 cents in this conversation.
We're excited to have you. Thank you so much for joining us. So our goal today is to candidly discuss our experiences as of late, and to also, empower our listeners for 2023 to get you guys prepared. Hopefully we'll provide some critical information that will help you guys make good business decisions in the coming year. So let's get right into it. Let's talk about our 2022 experience, real talk. So I'm going to go first. So I personally flip and I wholesale in a few different markets. And every market has been quite different as to how it's handled the interest rate increase. So what I have seen is that the lower price point market, so say sub 250,000 average purchase price, has not quite been affected very much. It's almost like business as usual. And the markets I'm talking about specifically for myself, it's Oklahoma City, Tulsa, and Pittsburgh, Pennsylvania. So those markets, I'm not really seeing a ton of price reductions. When we do get a property, maybe an off-market deal that we're trying to wholesale, we have no problem finding landlord buyers, multiple offers above asking. So it's pretty interesting. But if you think about it, kind of makes sense with interest rates. They don't have as much of an impact on a lower price point area. Now, I live on the flip side. I live in Orange County, California, and that's really weird, right? You're seeing these properties just sitting on the market. And the sellers are like not really, coming to terms with that. Their property now costs somebody $3,000 more a month than it did last year. They still want that price that they could have gotten last year. So it's really interesting. The other area I'm in, Boise, Idaho, we do some wholesaling in. That is one of those markets that had just a huge boom in the recent years and now kind of a huge bust. It's interesting, if you go to Boise, Idaho, and you just go on Zillow, pull the active sales, and it's like your screen is bleeding. Like it's just price reductions everywhere. So really every part of the country is kind of being affected differently. And it's been interesting for me because I'm in it and I'm in those markets. So it's been quite an experience. And it's made it difficult for me to decide what I want to do in 2023. Because I'm seeing certain areas, right? I'm going, you get your Boise vibes, then you go into Oklahoma, and you're like, well, but this is what's happening in Boise. Could this happen here? So to be honest and candid, like it's a little scary. It's especially for the flippers out there. I know that a lot of flippers are very, very scared. Sharad, tell me, what has your experience been in 2022?
2022 overall was a really good year for my real estate investing business. But we did lose about $15,000-$20,000 on a property. We typically invest in properties that are, sub 250,000. Feel super, super comfortable with, and our exit is, I would say, about 50% would be turnkey property selling to other investors, and other 50% would be, selling to homeowners. So we had purchased this one property for about $485, and the plan was to put about $40,000-$50,000 into it, and then sell it for $700,000. It was worth about $725. We figured, we'll list it on the market for $695. Make it a quick sale, and it started. We put it on the market right around April, May. When the interest rates started going up. And then I just knew right away that this was not going to sell for what we had thought. Eventually, we ended up selling it for $585,000 cash. And after interest cost and everything, lost about $15,000-$20,000. But that was one deal. Honestly, looking back, I was happiest about selling. We made every other deal we made money on, but that was the one. It could have been really, really bad in terms of if we had stubborn and just sit on that property for a long time. But overall, it was a good year. We did slow down looking at our marketing numbers. So I'm also owner and founder of REsimpli. So the privilege of looking at, data of like some really, really large companies and kind of, seeing the trends. And we noticed that starting September, October, the quality of leads, online quality of leads started dropping down, as like people just really started getting a little bit desperate about the interest rate, the property is not selling. So, we buy a lot of leads, pay for leads online, do our own PPC. We started noticing a lot more leads coming in that were listed on the market. Again, these are people that, that had their property on the market for some time, not getting any action, losing a little bit of faith in their real estate agent, and reaching out to cash buyers to see if they could make a deal. So we started going. So that was kind of 2022. But going into 2023, we feel pretty good about the year. Again, we're being very intentional about our target market. We're not buying anything that's over 250,000 ARV. Just by default, we're passing on it unless it's a really good deal. So that's kind of where we stand right now. We're doing as well as marketing. We're doing online PPC, pay per lead, and we're going to start picking up direct mail and cold calling going into next year.
Interesting. I love that you said the 250 price point, because that seems to be that sweet spot number, that I noticed as well. It's those landlord markets that don't seem to be feeling the heat as much. And I wonder if that has anything to do with the fact that home buyers are getting squeezed out of home ownership and they have to be renters because they can't afford to buy a home. So I'm interested to hear, Seamus, how has your experience, or what has your been experience in 2022, along with your TurboTenant customers, because you kind of have some intel, right?
Yeah, exactly. So I'll speak to just on a personal note in our rentals, and then quickly pivot into what we've learned from our landlords, because honestly, there's a lot more of them with well over 1 million units, so we get to see through surveying the data kind of what they're doing. I'll definitely plus one though what you said around that 250 from a personal experience standpoint. We got a great single family home in an awesome part of town near our rentals that was right around that 220, and it's because there was actually some problems with it, which was going to make it challenge to pass inspection, because we didn't need a conventional mortgage for it. We were able to grab it, do the work, right, and get it rented out pretty quickly. And so the other thing we did though is we actually sold what I would consider an underperforming property we had in our portfolio, and we actually closed on that Friday of last week. Which was a big surprise. I thought there was no chance we would. It was a small single family though, great for a first time home buyer. That was around that actually like 140 to 160 range. And I know based on where you are in the country, those don't even exist. We had one and we were in a joint partnership with that, and it wasn't worth it personally in terms of the cash that we were taking off that. So we decided to liquidate that. We also had a feeling that the partners may want to do that in the future anyways. And I was like, all right, let's get it off the books this year. So from that price point, we haven't seen huge changes, or I guess we feel at a real advantage to not be relying on a conventional mortgage all the time. For our landlords though, what's been really kind of really interesting is that we survey them periodically throughout the year. So at the beginning of this year, 30.7% of our landlords said that they plan to purchase a property. Then fast forward to the ones that we've done at the beginning of December, it turns out 43% of them did. And so they were more pessimistic at the market at the beginning of the year than they ended up being throughout the year. And we largely attribute that to the fact that a lot of them can utilize other sources other than a conventional mortgage to purchase those properties. And so as traditional primary residence home buyers are getting squeezed out a little bit, there are more opportunities to come in with whether it's cash because you have hard money lending, or you have equity in other properties to grow the portfolio quite a bit. So that was a huge surprise to us, that more people than anticipated growing their portfolio actually grew their portfolio throughout the year, and that's representative across the country from our users.
That's really interesting. And Devon, how has 2022 treated you?
I can't really talk about 2022 without talking about like the last quarter of 2021, because it really depends the market, because I'm in Ohio, Kansas City, Tampa, and Tennessee, and Arizona. But speaking of Ohio, in the fourth quarter of 21, I had issues with the county, and they were lead-based paint, and they were making all landlords come in and solve lead-based paint. But the solution that they presented was something that was going to cost $4,000 or $5,000 for almost half of my portfolio, each property. So, that's what my property management came in and introduced to me. So as you guys can probably imagine, I'm doing the numbers and I'm living, and like, I'm about to get out of these properties. I can't believe the county's trying to drop this bomb on me. And before I did, it led right into 2022, and I decided to see the value of my properties, and I met a portfolio lender, and I was able to, get some quotes and figure out what I would do if I were to just get some of my capital out. And I go through the process and realize I can get all of my capital out. So I bought 6 properties in Cleveland, Ohio in 2018 for $600,000. So it was about $100,000 a property, C area in Cleveland, Ohio. And then I was able to get $620,000 out and still be able to conservatively cash flow between $12,000 to $16,000 a month. But I lost faith in my property management. So I kind of had to go on the hunt of finding new property management. and trying to get these properties more stabilized because, you know, I just felt like they weren't being managed properly. So that was one, you know, deal at the beginning of the year. And then towards the end of the year, I started to realize I bought a lot of turnkey properties, and you guys are talking about, you know, flips and large renovations. I haven't had the luxury of looking at deals that way because I'm in the NFL, you know, majority of the year, I'm playing football, I'm training, I'm doing these things. I can't manage a flip, and contractors are hard to trust. So it's like, I'm already investing out of state and I got a full-time job that's taking a whole lot of time. So, you know, I was able to build a relationship towards the end of 2022 with a group out of Tampa that I felt strongly about. And I did my first value add duplex, and it's going great so far. So I got one of the units rented out. The other tenant isn't going to be out until April of 2023, but they're only paying $1,500. And I think as soon as I get them out and renovate it, I'm going to be able to charge $2,300 in rent. So a large rent increase that I'm expecting in that other unit. So, you know, I've had a good experience actually in 2022, but, you know, I had to preface it with the whole lead thing in Ohio to end 2021.
I'm actually glad you brought that up because I would not have thought to bring this up, but it does seem that it's difficult for us investors to find contractors, property managers. I don't know if you guys have heard this, but there are a lot of hedge funds that are really struggling right now because they've been gobbling up homes over the years. And in Pittsburgh, Pennsylvania, I will not name the hedge fund, but they had like 190 properties that they could not find general contractors for, and they have been liquidating them. And I've been seeing, specifically in Pittsburgh, a lot of properties like half remodels or like 25% remodels where people like bought and they can't find contractors, or people are having a difficult time finding property managers. I think it's just because there's this influx of investors. Have you seen, I mean, Seamus, have you heard anything about, you know, hedge funds kind of struggling to fulfill their properties, their property goals?
I would say so. As you know, as a CEO of a company that serves independent landlords and real estate investors, I get asked all the time whether or not we view that as a real threat, right, to the individual that wants to, invest in real estate. And we don't. The reality is, it's much harder than it looks, as you're kind of describing. For that reason, the other thing is this market is huge that we're all in here. The institutional investors, well, they own, you know, if you go to Phoenix, they have a large presence there. Some of them do. Across the country, it's like 1% of the entire rental market, right? So it's a very small portion that they're actually influencing. And so, I'm not surprised to hear that they're running into those problems. For those of us that have done it, like boots on the ground, we know that having the capital is just part of the equation, right? It's the part that hedge funds are extremely good at. But there's a lot of other pieces to it that make running those investment portfolios not wildly simple and not wildly scalable, because Pittsburgh's a different situation than Columbus, Ohio, than Albany, New York, or any other place.
Oh, 1,000%.
Well, you know, I'm in Phoenix, and I'm seeing it, you know, open doors getting crushed right now. I feel like we can't talk about 2022 without talking about some of the stuff going on with that. And I mean, not too far from where I live, there's a 2-bedroom, 2-bath condo that they were wanting $500,000 for, and I'm trying to steal right now for like $350. You know, and I really might get it. And it's like, you know, how do you miss on $150,000, but they're just overpaid and are expecting more than they can actually, you know, get. And I'm seeing that a lot in the Arizona market.
Oh, absolutely. I mean, hedge funds and iBuyers run very similar, right? Like their business models are similar, and they are relying on employees who have absolutely no repercussions if they buy a bad house, and they're bonused on the more houses they buy. So their compensation plan rewards bad behavior. So like, you know, they're shocked that like they have houses that, you know, are total, like that they bought too high. I mean, come on, right? I always felt as well that this would happen. Like there's no way this would work, right? So it's interesting
Yeah,
to see that play out. And I'm glad that we talked about that and touched on that. Well, let's get into some predictions, guys. I don't know, everybody's so funny about their predictions. There's some people that are like willing to actually say what they think are going to happen, and then there's like I don't know, it could go up, it could go down, it could stay the same. So we'll see how what all of us think. I'm going to start though with some stats. I wrote some stuff down and I wanted to share this ahead of time, and then we'll go around to the panel. So the National Association of Realtors has just reported that existing home sales are down for the ninth straight month. Currently, existing home sales are down 28%, 28.4% from a year ago. Yet the median existing home sales price rose to $379,000, which is an increase of 6.6% from the previous year. So that increase is likely due to the lack of inventory. NAR chief economist reports that more potential home buyers were squeezed out of qualifying for a mortgage in October as mortgage rates climb higher. This clearly has impacted some markets more than others. The markets that are more expensive or markets that had witnessed significant home price gains in recent years are now feeling this the most. So that is pretty much what I experienced in 2022 to sum it up. I wanted to start with that. Seamus, based on everything going on, what are some of your predictions for 2023? Do you have any predictions? Oh, you're on mute.
Thank you. We were reminded before this started to get that right and failed there. Anyways, in terms of 2023, so once again, I'll look to our landlords and what they're thinking of doing. In this December survey, 50% of them actually said they plan to purchase a property in 2023. So as I mentioned earlier, it was only 30% at the beginning of 2022 said they thought they'd purchase one in 2022. And that's at 50% now for 2023. And we honestly scratched our heads about that a little bit. I mean, I think by all accounts, it feels bleaker today than it did at the beginning of 2022.
Yeah.
But if history is kind of a prediction of the future, and you go back and look at where there has been large housing price corrections, and because our landlords are interested in the rental market and not flipping, right? Price corrections haven't impacted rent that much. Like in 08, rent prices kind of plateaued, right? They didn't drop alongside the drop in home prices. And so from that standpoint, I think a lot of our landlords understand that as a savvy investor, when housing prices drop, is an opportunity to buy, right? Especially if rent is going to stay elevated from that standpoint. And so when I think about it more, I'm not too surprised about that data. I do think, though, that landlords have to think about ways in which they can save money. We're excited and talking to more of our landlords that sign up every day. A lot of them are coming from property managers, and what they're realizing is for that 10% fee per month, they weren't getting that much. And so they're turning to software solutions and other solutions to actually self-manage, because if you have, even if it's 5 properties, right, and you can save 10% a month per property, that's a non-trivial amount of cash that's going to go into your pocket from that standpoint. So we're optimistic in terms of the independent landlord continuing to acquire rental properties and look to self-manage them to save a little bit of extra money and not have to worry about rent backsliding too much.
I love it. Sherrod, what's your prediction? What do you think is going to happen in the coming year?
I think it's going to be strong. I mean, the fundamentals of the market, there's still housing shortage. I mean, nothing, the higher interest rate has not changed that. For me, I base my decisions based on numbers. There's always going to be demand for houses, affordable housing in good neighborhood. You were talking about median home prices. Yes, they have gone up since in last year, but if you look at it, they peaked at, I think, in June at 413,000. So it's actually come down a little bit, even though they're higher from last year. But if you look at from like last 4 or 5 months ago, they've come down. So in my market, I can just speak, based on my market, what I'm doing, if you look at, if I look at a $200,000 house that, I want to buy. So if I'm interested in buying a $200,000 house, and let's say, in our market, somebody can buy, can qualify for an FHA loan. So they're putting about $7,000 down. And then in our market, I'm sure it's very similar in a lot of other markets where, the seller is giving credits to the buyer, like, $3,000-$4,000. So let's say somebody is looking to buy a $200,000 house. They're putting $7,000 down on that house, and you're giving them about $4,000 or $5,000 credit. I mean, in some cases you can, you can give a lot more credit. But let's say even if you're giving $5,000 credit, so this person is coming out of pocket with $2,000, and even if the interest rate, is 8%, which is a lot lower. But let's say even if the Fed increased the interest rate by 0.5% just today, like you were mentioning. So even if the interest rate is 8%, the mortgage payment on that house is going to be $1,600, $1,650. And when you look at how much that house is going to rent for, it's going to rent for more than what they would pay on that mortgage. So when you look at from an economic point of view, and then just not even considering like the emotional aspect of like everything else being equal, people would want to own a home. So if you look at from that point of view, people can actually in markets like 150 to 200 $250,000 price point, somebody can actually own a home and put less money owning a home, in terms of like down payment, that actually give towards, rental deposit and whatnot. And then their monthly payment would be lower than what they would be paying, if they rented the house. So I believe there's going to be a strong demand. I mean, of course, like when the interest rate goes up, there's always, there's going to be panic about, oh, interest rate is going up, but that affects definitely much higher price point, like once you start going $500,000-$700,000 price point, that's where you start seeing the real impact of the interest rate. But at the $150,000 to $200,000 price point, once somebody gets over the shock of the higher interest rate and they actually just look at fundamentally, just look at the numbers, it still makes sense to own a home financially than actually going out and renting a house. So that's kind of what we're saying. And then and there's the rental rate is not coming down. The rental rate is going up. So I think with the demand and supply, I think it's still going to be balanced. But again, but that 150 to 200, at least in our market, it's going to be different based on different markets. But in my market, Northwest Indiana, $150,000 to $200,000 price point in good B and above neighborhood, I believe there's going to be a strong demand, and that's kind of what we're focusing on. Some other like C, D neighborhoods that we were buying previously, we've just completely stopped buying anything in those markets, nothing for rental, nothing for turnkey, nothing to sell to homeowners. We're buying in strong neighborhoods, and we're still seeing very strong demand in those markets.
That's interesting, and thank you for sharing. Devon, what do you think is going to happen in 2023?
I think, both Sharad and Seamus know more than me on that. My perspective has always been like, I'm going to be ready for, whatever. I kind of have the mindset of, I don't know exactly what's going to happen, and I don't like trying to predict, but I do feel like there's going to be opportunity, and I want to be in a position, and I, encourage everyone listening. Are you in a position to take advantage and identifying a market that works for you, that fits what your buy box is, and can you go attack that market? And those are the things that I'm starting to think about doing. And what advantage do I have? Well, I'm lucky to be in a professional athlete and have some cash liquid and connections to where I can get different lending opportunities and creative financing to where I might be able to get deals on properties that I wasn't able to get. And I'm transitioning out of turnkey more into value add, because, if I can find a value add type of property where I need to renovate for cheaper and, force equity into it, if prices stay as high as they are, then I'm putting myself in an advantageous situation. So I think I see too many people kind of getting scared. And instead, you can buy in every market. What works in the market that you're trying to buy in? And do you need to change markets, or, does your strategy need to change? Having that mindset instead of sitting on the sidelines, I think that's what every investor and everyone, kind of looking into real estate needs to kind of think, because I think there's going to be opportunities out there for those who are willing to kind of do the work.
I love it. I love it. And I totally agree with you. I think that, you can always be a buyer. There's always going to be real estate investing to be had, but you have to adjust your strategy. I haven't talked about what I think is going to happen. I almost got out of making a prediction. You know, I'm not a doomer gloomer here, but I'm going to sound like one. I think certain markets, there's going to be a correction. And I think that there's like a difference between a correction and a crash. All right. So a crash is like unemployment's going up. We have a ton of foreclosures. That's something like the 2007 era, right? I don't think that's going to happen. We don't foresee very many foreclosures coming up. Employment's pretty good still. But I do think that a correction is due, especially in high priced areas like my market, Southern California. I mean, now the homes are completely unaffordable. So I think that certain markets are going to be affected more than others, and they already are and already have been. So I think certain markets, there will be a bit of a correction. I don't know how much. I've heard different, publications stating different numbers, but I've heard 10% has kind of been a common one that I've heard. But I don't think that that's every market. That might be Orange County, LA County, San Diego, but that might not be Tulsa, Oklahoma, or where Sherrod in Indiana, right? So I do think that certain markets will be affected much more than others, but I do think that those certain markets prices have to come down. So that's my prediction. Let's go to strategy. So what are we going to do about it? So personally, I'll tell you what I'm going to do about it. If it comes to house flipping, before I buy anything, I am subtracting 5 to 10% off the after repair value to make sure I'm going to be in the green. So if there is a correction, typical flip hold time is 6 months. I doubt, historically prices haven't dropped that quickly, but a 10% buffer should keep me in the green. So I want to make sure that I'm in the green. I've asked a lot of people what they're doing, a lot of fellow flippers, and that seems to be kind of the magic number. But in Pittsburgh, Pennsylvania, I don't know if I have to go 10%. So again, it's kind of market to market. And personally, I think this is a really good time to tighten the belt a little bit, like get rid of any unnecessary business expenses. Cut the fat? Do you have any employees sitting around that you don't really need? I personally cut the fat in preparation for a recession. The other interesting thing that I have done, because I've dealt with so many construction headaches in this previous year, I, with a partner, have actually started a construction company, and I'm going to be focusing a lot of my efforts on building a construction development company, because there is a huge demand for general contractors. So I'm also taking advantage of some opportunity right now. So I'm kind of less focused on the investing side and more focused right now on building that business. Sherrod, what is your focus right now, and how are you, strategizing for 2023?
Focus for me is just, it's the fundamentals. I think, just focusing on looking at the numbers. Again, that $150,000 to $200,000 price point, there's multiple exits that we have, right? I own a property management company, so at that price point, we could sell it to an investor as a turnkey property. We could sell it to a homeowner, and in worst case scenario, we could rent it out and keep it as a rental property for myself, and my property management company could manage it. So for me, the way I'm looking at this is, okay, if somebody's buying a house, we're looking at that again, $150,000, $200,000, $225,000 price point. These loans, these houses would qualify for an FHA loan. If somebody's putting, 3.5% down, and then we're giving them about 2-3% credit when they're buying a house, how much is their monthly mortgage payment versus how much they're going to pay on rent? When people are buying a house, they're how much house they can afford is not based on, how much house that they want to buy. It's based on the monthly payment that they can afford. So if you look at that, it starts out by how much they can afford to pay towards monthly payment. And if you look at that number, that's the most important number that people have. And if you compare it to the rent, and if the rental number is going to be higher, about 10, 20% higher than what their mortgage payment would be, then to me, I think it makes sense for somebody to buy a house and rent a house. So that's kind of what we're focusing on. We're seeing strong demand in that price point, and that's what we're going to double down on. And anything in lower price point or higher price point in C or D neighborhood, we're just passing on it and just doubling down on like B neighborhoods for us.
What about a high price point in an A neighborhood?
High price point in a neighborhood?
Yeah, like
No,
you're not touching
I have to know, kind of what my strengths are, what my contractors are good at. To be honest, like the contractors that we have, they're really, really good at working on B class houses, but they're not good at working on A class neighborhood houses.
Right.
With the higher interest rate, people have higher expectations now. There's not one house on the market and you have like 10 people making offers on it. You have multiple houses on the market and people have options to go out and look at what house they want to buy. And I have to know the team that I'm working with. I mean, they're absolutely phenomenal at working on those B class neighborhoods at $150,000 to $200,000 price point. But once you start going about 250, 300 or above, people have a little bit higher expectations, and I don't think I have the team for that. And I do not want to build a team. I just want to double down on the strengths that we have, then rather than like trying to work on our weaknesses. So.
Oh, that makes sense. And we have a viewer who asked a question, which is in line with Seamus's prediction. So I'll go ahead and ask it. Beyond saving money, would the panel recommend small landlords focus on next year if they're looking to sustain long-term growth? So I feel like Seamus, you're the one to answer that question.
Yeah, sure. It's a great question. In terms of sustaining long-term growth, I'll speak at growth in terms of growing the portfolio, as well as just continuing to manage the portfolio they have. One suggestion that I would look to is turnovers are expensive, right? So now, as much as ever, make sure that you are building a strong relationship with your tenants, that you're staying on top of things. The stronger that relationship is, the more likely you are to get rent paid on time, right? For them to take good care of the property and reduce some of those maintenance costs. And so that's something that we always we always suggest, especially because our users are self-managing, right? So they have the opportunity to actually do that and make sure that goes really well. When you're looking at new properties in terms of saving money, for us, or for me personally, we always think about when we're acquiring a new property to actually make sure that we're not cutting corners when we're doing any repairs or fix-ups before we get tenants in there. It's always cheaper to do those sorts of things up front now, as opposed to later on in a reactive mode. And so it sounds a little bit, because things are expensive today because of inflation and things like this, it sounds a little bit backwards. But like if we buy a property that we know is going to need a new roof in a couple of years and it's currently vacant, we are doing the roof right now, right? We're doing those repairs. We're putting in a better quality hot water heater and things like that, just because prices always go up, right? This inflation right now, it's not like roofers are going to drop their prices of roofing in 5 years from now, right? It's not like a dishwasher is going to get a lot cheaper next year if inflation drops. Like prices tend to go up and they tend to stay up on things. And so another thing that we're doing right now is actually a little bit more of that upfront investment, knowing that we have a long-term ROI strategy over decades, and it's worth it for us to do right now and have a property that is a little bit more hands-off for the coming years and the coming lease cycles. So that's a big thing we suggest. I would suggest that I do with my own properties. And then the last thing, it's not necessarily for the small landlord, but when you look to 2023, a lot of independent landlords, independent real estate investors are using HELOCs or lines of credits on their current portfolio, right, to purchase that next one. That allows them to do a cash purchase on the next one. They then look to refinance that in several months. And so when interest rates are really low on those lines of credit, it feels like you're getting free money, right? You've got that money in 3 months, you do a refinance, the property's cash flowing, it's full. Honestly, it was really good the last handful of years. A suggestion I would have is just that people look at that strategy that worked really well before and just do the math this time, right? Those lines of credits, those are adjustable rates, those are changing, right? The amount of interest you're going to pay on that is different than what you would have paid a year ago. And the refinance process is not as smooth today as it was previously as well. And if you go back to 08 and 09, the refinance process got really, really tight, right? And so I do think people should just be cautious as they wade into new purchasing opportunities when they're expecting to be able to move money from account to account in their own personal portfolio. So that's another thing in 2023. I think that people just have to, you can't be sloppy with that. Honestly, you could be sloppy with that the last handful of years and get away with that without really any consequences. And I think it's going to bite people in the ass if they're not paying attention this time around.
I agree. Thank you. Devon, what is your strategy? What are you doing in 2023?
As I was listening to Sherrod and Seamus, you know, the main thing I think about, you know, for 2023 is quality. Like I want better quality properties. I've done a lot of C class, and I heard Sherrod talking about B class, and that's what I kind of want to do. Get into more B class solid areas, get better tenants, you know, do better renovations because I want to do more value add, and really kind of I don't trust that the leases are going to continue to go up what I'm able to charge in rent. So I'm looking at my day one, what I think I can charge day one for my, you know, leases and with my tenants. And I'm kind of saying, am I comfortable with that if that stays that way for a couple of years? I see a lot of pro formas where it's, you know, aggressive. They're going to do this rehab and they're thinking, you know, they're going to get $400 more in rent a month because of that. And that may very well be true, but I'm underwriting more conservatively. So I would say quality and conservativeness is kind of the staple of what I want to stick to. Because if you do it that way, then if you over exceed, that's great. But I don't want to be on the other end of that where I'm, you know, thinking it's going to be so good and you know, I'm underperforming consistently. So I think those are the things that I'm really focused on is B-class neighborhoods and tenants like it. My most recent property in Tampa, I found a great tenant. It's a mother and a daughter, and hopefully they're going to be long-term tenants. And I did 2 years instead of one. You know, I'm okay with that rent not going up, and I'm going to leave them where they're at. And, you know, for 2 years, and if they want to re-up, I might raise it just a little bit, but I'm not gonna you know, knock them over the head because from my experience, turnover cost and finding good tenants is hard. And I feel like I found one, and I want to kind of ride that, you know, consistently and allow the appreciation over time to work in my favor. So I think patience is the last piece of that for me. Is I'm willing to be patient. You know, I'm not a flipper. So for me, I want to hold and I want good cash flow. So can I accept the cash flow on day one? And, you know, is that something I'm comfortable with? And over time, is it going to go up? And is this property going to appreciate? And when you kind of combine those things, I feel like you have a successful plan that can work and that's going to allow you to be able to leverage that, buy more properties, and grow, you know, a strong portfolio that, you know, you can depend on.
I think it's interesting how you say that there are people that are kind of putting on their pro forma that rent is going to go up, you know, this, and this. And you also mentioned that you invest in some syndications as an LP, as well as a GP. And I'm curious, both of you and Seamus, on that, because I know I've seen a lot of funny business with syndicators, and they seem to be very overzealous with what they think they're going to be able to charge, and then in the end sell this apartment building for in 7 years. And I'm just slightly skeptical on that, especially because there is so much multifamily development right now. I mean, everywhere in every city, there is so much multifamily development. What do you think about that? Like, syndicator specific?
Yeah, you know, looking at syndications, I feel like it's so trendy to be in multifamily, and that scares me because everybody and their mom is trying to do it right now, or wants to be able to say that they invested in this multifamily unit, or they're syndicating this. And for me, I've been doing it for some years, and I stick to the ones that I feel like are tried and true. and I'm not taking on, too many new syndicators that are kind of coming out of the woodworks. And that's the first thing, but also it's the glaring stuff in the pro formas when their rent increases are, kind of outlandish and it's just unrealistic in my eyes, to where it's like, you're doubling rents. You think this is, you're going to have a 20 plus IRR in the next 5 years. And it's just like, once you've looked at enough, it's like, all right, especially in this climate, how are you being this aggressive? Maybe you hit it and maybe you're that good, but going back to what we were talking about, I like to look at things conservatively. And when I see, syndicators and general partners coming in and pitching, deals that are that aggressive, it scares me, honestly. And I think there's going to be a lot of people that kind of, lose out in the next couple of years because of those kind of actions. Because I've just seen some bad deals come across my table that I've seen people get into, and my recommendation is make sure you don't just, everything that glitters ain't gold. Don't believe everything everyone's saying, and that kind of ties into social media. These social media people, I'm on Instagram and Twitter and all that, and they're driving me crazy, making it seem like investing in real estate is the easiest thing in the world, and everyone and their mom can do it, and you're going to get a 20+% return like it's nothing, and invest with me. And I think I'm glad we're able to have this conversation and everybody's able to put their 2 cents in a real way, because this is what's really going on. And you can be lucrative and make good money in real estate, but it's not what, the things I'm seeing on social media and what they're telling you. And I don't know if I'm wrong, and maybe like I'm not as good as you guys are at some of this stuff, but I'm just like, man, my experience in investing, whether it's syndications or my personal portfolio, is not what I'm seeing, people talk about on social media.
Oh, 1000%. I'm so glad you brought that up. Being in the education space, right? Like I'm in it, and I'm definitely seeing a lot of interesting influencer posts on social media that are, it's turning into this almost like multi-level marketing vibes, like, but for real estate. It's like, join this and do this, and it's awesome, and you're going to make all this money. But in reality, everyone that I talk to is not having those experiences. But it seems like these real estate influencers are getting louder and louder, and their claims are getting bigger and bigger and more unrealistic. Like, it used to be a big deal that I did 55 wholesales. Like, I remember that was like a really big accomplishment, and I was respected for that. But then now the next guy's doing 155 a month, and you're like, well, I'm sorry, but like, I can't beat that, or I'm just not gonna lie. Like, I don't know. So it is interesting that, and I feel like that has been a product of 2020. People, coming. It's like 2020 was the year of the influencer. And it's just those influencers competing with each other, when I really question if any of them are really in the business altogether. So I'm glad you brought that up. I'm glad you brought that up. Now, Sharad, I think we have a question from a viewer, and I'm going to take it to you. We have one more question. Hold on, I lost it. Oh, Sharad, what is your marketing recommendation for 2023? A viewer asked, Sam Fitzgerald. And he's a big fan of REsimpli. So am I.
Awesome. Thank you, Sam. For me, I mean, that's one of the most frequently asked questions at which marketing channel, I should go after. My answer is always the one that you can stick with for at least 6 months. At the end of the day, every marketing channel works. Like, people are making money from SMS, cold calling, TV ads, radio ads. At the end of the day, everything works, but there's a couple of things you have to look at. First thing is to look at your budget. You have to look at, also like what your comfort level is, what your personality is. Like, for me personally, if I had to do cold call, I would just look at another profession, because that's something I'm not good at. I have to be honest with like what I'm good at, but I have people on my team that can cold call. For me, I personally love inbound marketing. If you can have, just think about it. If you can have people that are reaching out to you, wanting to sell their house, making the first touch on their end, rather than you reaching out to them, it just naturally, it's going to be higher quality leads. So if money is not an object, if you're not concerned about like the budget and depending on the market, I would go after like inbound, like TV, radio, paper lead, PPC would be the ones that I would start out with. And then one thing I would say is, I was talking to some other investor yesterday. So we have investors that are using our platform, from people that are just starting out to doing 30, 40 deals a month on a consistent basis. One thing we do notice, people that are consistently doing deals, is one marketing channel that they all have in common is direct mail. That's a very, very interesting thing we notice. Some people might be using it as their primary marketing channel, and some people might be using it, to some niche list. But direct mail is one marketing channel we notice consistently. Every investor that is doing consistent deals, like 4 or 5 deals or more a month, is doing some direct mail to some list that they have. So, but if you're starting out, I'll look at all the inbound marketing leads and see how you can get started with that. And then after that, if you're doing outbound, I would look at direct mail. But having said that, if you're gonna just try something for like a couple of months, then I would not do anything. I would commit to whatever marketing channel you use at least for 6 months to be able to say whether it worked or not. If you're gonna do something for 2 months, then I wouldn't do anything.
Love it. Well, guys, we covered a lot today. And if there is any more questions from the audience, please send it over now, because we are going to wrap things up. Do we have any final words? Seamus, I'll go around to all the panelists. Make sure that you, A, final words, B, let people know where they can get in touch with you or follow you, drop your socials, drop, your URLs. This is your moment. So Seamus, go ahead.
My moment, huh?
Moment.
All right. And in terms of final words, I think it's important to remember that these times that create a lot of good opportunity for real estate investors create a lot of hardships for primary homeowners, right? There's a lot of people that would love to be buying their first home right now, and they just can't because of what we talked about: interest rates going up, home prices going up. And so I don't know, we always try to keep them in mind as well. And while it's an awesome opportunity for the independent investor, as you mentioned, like those, some of the social media presence of like how amazing it is to be these individuals, I think it creates animosity, and that's something that we don't want to create, right? In our industry, kind of animosity between the real estate investors or landlords and their tenants. And so that's something we try to be mindful of. In terms of things I want to shout out, so TurboTenant.com is the company that I run, and feel very fortunate to do so with a bunch of awesome humans here in Colorado. As I said earlier, we've had over 500,000 landlords sign up to use the platform. Individuals that are currently self-managing and want to bring their processes online, individuals that have used a property manager, or we have people that closed on their first rental last week, that joined the platform and use our product to just make it a lot easier. And the great thing is it's free for landlords, so kind of nothing to lose. So people check out anything and they're considering self-managing, or they are self-managing and want to just reduce the friction and kind of level up, that's a great place to go.
All right, Devon, any last words?
I want to start out, I guess, by just thanking all of you guys. And, Seamus, I want to kind of hit you up on TurboTenant, because as I start to buy more stuff in Arizona, I want to manage my own stuff. So I think you can help me. And Sharad, REsimpli is amazing. So keep doing what you're doing. Being an investor myself, the software you guys are creating to make investing easier, you guys are giving me reason to be able to go into locker rooms and go places and tell people, hey, you can invest. There's tools you can use to make it easier. And I don't think like you guys realize how impactful software like that is for people like myself, who doesn't have all the time in the world to do what you guys do. But you're speeding the process up. You're helping me be organized. You're helping navigate. I think that's huge, and I hope everybody out there takes advantage of that. And last message, for me personally is just, I want everyone out there to enjoy the process and keep growing. Wherever you start. My first property was in Beech Grove, Indiana. I don't know, Sharad, if you're familiar with Beech Grove since you're out there, but that was my first property.
I don't know of any beaches in Indiana.
It's a town. It's called Beech Grove, Indiana, but it was for $86,000, and I put $12,000 down. Real estate can be very daunting, but you can start small. And reason why I started in Beech Grove, Indiana, for an $86,000 3-bed, 2-bath is because that's what I was comfortable with at the time. I wanted to start small and do something that I felt like was going to get the ball rolling. And since then, I've been able to invest in 21 more properties and be able to have the opportunity to meet people like Seamus and Lauren and Sharad. So for those who haven't started yet, figure out a market that works for you and get going. You're going to thank yourself a year from now. There's no deal too small. You don't have to believe in those people who say go big and you got to buy a 10-plex right away. Find a small house that works for you and get going. And, that's my last words, I think. And you can find me at Devon Kennard on all social media, and my website is www.devonkennard, so pretty much my name everywhere. And I'm also going to be releasing a book April 18th. I can't say the name of the book yet, but you can go to my website, pre-order everything, and I appreciate all the support.
That's awesome. All right, Sharad, any last words?
Yeah, first of all, thank you so much for hosting this panel. It's been really, really great. Thank you, Devon, Seamus. Really fantastic, discussion. One thing I would say is, look, there's money to be made in every market. You just have to know what you're good at. Like Lauren, you were talking about, don't follow somebody on social media and compare the highlights of their life with your lowlights. I mean, a lot of that you see on social media is not true. You have to know what you're good at, like what your investment strategy is. If somebody's out there wholesaling 50 houses a month, 50 houses a week, more power to them. If you can only wholesale one house a year, just focus on that. I mean, people have different backgrounds. They have different resources available, but there's money to be made in every single market. And I would say, I used to be an accountant, I used to be CPA, so that it's always just by default, look at the numbers. If the numbers make sense, like Devon was saying, if the numbers make sense right now when you're buying the house, buy based on that. Don't, speculate that the rent is going to double, next year, and then you make your decision based on that. Just look at the numbers. Does it make sense for you to buy a house, investment property, whether you're buying it as a fix and flip, whether you're buying it as a rental property? Do the numbers make sense right now? If they do, then feel confident and be as efficient as you can be with the process. Don't waste money on things that you don't need to. Just see what other investors have done. You can look at, if you're flipping a house, look at what other investors have done. Don't try to watch somebody on HGTV and then try to outdo their design. Just see what your market, the houses that are selling in under a week, just see is there something in common with them, right? I mean, if all of them are using like a gray paint, stainless steel appliances, with a certain brand with a backsplash, just follow the process. Just learn what other people have done successfully. Just do that and just repeat the process. Once you have a process, just repeat the process day in, day out, and then things will work out.
Thank you for that, Sharad. And guys, what is my advice for you? Man, I think this is going to be a time where those who are swimming naked will be exposed. So I think that this is a time to be better, to really hone in on your craft, focus on the fundamentals. I think the people who sort of got into this business, they're amateurs, there was no way they could fail because the market was going up and up and up. I think that those people are going to really need to go back and learn the fundamentals of this business, or maybe find something else to do. But those who are committed and serious about being better investors, I think this is just that time where you cut the fat in your business and just focus on the fundamentals. That's all you really can do. So I personally can be found. You guys can go to my main website, which will kind of direct you anywhere. Go to laurenhardyco.com. If you are looking for an e-course on virtual wholesaling or virtual investing, I've got a course there. And if anybody is in SoCal, specifically LAOC, Inland Empire, or Northern San Diego, and you're looking for a general contractor, make sure you hit me up. All right, guys. Well, thank you so much. This was so much fun. Hope you guys got a lot out of this one. Hopefully we'll be able to do this again. Maybe we should do a quarterly follow-up. I vote yes. So guys, thank you so much for joining me today. We'll see you guys next time.
Awesome. Thank you, guys.